if you want to set up your own business, I guess you need to roll a little bit with the punches. It's my experience. I never believed in absolutely, totally fixed plans. I think it's really important to have a clear vision and a clear roadmap ahead. And it's equally as important to have the flexibility to deviate from it when there are roadblocks and stones in your way, or when opportunities arise on tangents that you can go after. I had a strategy, a high-level strategy, and when I understood what the money was looking for, when I thought I understood what the money was looking for, I made the strategy fit the money, as we probably do now as a business. It's not that we don't have conviction, but it's that the money needs a certain kind of approach.
Welcome to the People, Property, Place podcast. Today, I'm absolutely delighted to welcome Sascha Lewin to the podcast. Sascha is the founder and CEO of WRE, a B Corp best-in-class developer. With over 20 years of commercial real estate experience, Sascha founded WRE in 2013 with a clear focus on value-add investment opportunities that improve the spaces we work, play, and live in. Prior to establishing WRE, Sascha was a partner at Stenham Property, a real estate PE fund where he managed value-add strategies with a volume in excess of 1.5 billion across Germany, the US, Switzerland, and the UK. Sascha, welcome to the podcast.
Thank you very much. Thank you for having me.
Not at all. Well, look, we've had some really good feedback on the podcast recently, and especially around founders of businesses who've shared their entrepreneurial background and story, some of the highs and some of the challenges of setting up their own business and the route and the reasons why they went down the route of setting up their own business. So I'm really excited about tucking into how WRE came about. But before that, we always start the podcast asking a question: how did you get into real estate, and why did you get into real estate?
My route into real estate wasn't traditional. It was originally, actually, I started my career in financial communications. I worked promoting IPOs and share offerings to institutional investors globally. And after about 10 years of that, decided that there wasn't a career that I was enjoying, and I didn't really see myself in the investor relations business for too long, and retrained, went to university and started working for a real estate firm. And that was my beginning into property, but I came through it through the financial side. So I became not quite a real estate banker, but more on the investment side. So working for private equity firm, and then ended up working for a developer, and then moved back into private equity. And that kept me busy for the next 10 years before I set up, 15 years probably, before I set up W Real Estate. So
how old were you when you retrained? Did you go to university out of school? Because you grew up in Germany, right?
I grew up in Germany, but I went to university in the UK, and I was 29 when I retrained. 30. So I took a postgraduate degree at NYU in New York. I'd moved out there. There was a reason. I had an opening to go into real estate, but it required me to do that retraining. So I took that position and went back to school for a year.
So as part of you landing that position or securing that position, you had to do the course.
Yes.
And how did you pivot out of, is it investor relations or PR communications, you say, into real estate?
It was through a relationship I had on the investor relations side, and I was really excited about that business. So I in the end interviewed for that job, and they said, we can give it a go. We like you, but you need to invest into it with, some additional training. So I did.
What was the kind of personal cost or personal opportunity cost at that stage? 29, 30 years old, having to kind of maybe restart your career over again?
That's a good question. I think at that age, the world was my oyster, and I was super confident this is going to just be a very easy, amazing run, and felt there's very little to lose. I wasn't married yet. I didn't have children, and I had kind of the financial means, I guess, to take that risk, at least give it a try. And so I did. It gave me an opportunity to move to the States, which wasn't something I had dreamt about, but a really exciting time to be in New York, end of the 90s. And so I took that chance. That was really, really exciting to do.
Did any part of you ever think that you were kind of taking a step back in terms of your peers, or was it very much a step back to go a few steps forward?
Oh, fully. But I was really keen to make a move out of my current role. I kind of had, for some time, had felt this was coming to an end. And within that very specific niche that I was operating in, there wasn't a lot of space to grow into. So it was either moving into banking or moving into something financial related. That was my background, and real estate was kind of the area that I knew best, or enjoyed best. Actually, I wouldn't say knew best. My father was in real estate, and so I had some personal connections to that industry, and thought some place I want to spend time in. And then an opportunity came up, and so it didn't feel like a big step back. It actually felt to me like a step forward. But yes, it involved going back to school, but that was exciting. It's the first time that I actually really wanted to learn something. Didn't just go through the motions of university after graduating high school.
Yeah. What part of real estate was your father in? And how did he access that?
She was commercial real estate, but worked in Germany. Businesses were different than they are today, so they weren't so specific in terms of. But it was, I guess, what would be an investment manager today.
Yeah. So he acted as a bit of a sounding board or a mentor, or gave you a bit of advice around this kind of pivot.
Absolutely, yeah. So he was definitely. It was a big part that I took this step. So he was part of that whole, and I gave me confidence as well.
Yeah.
I could go back and ask and do.
So you went to New York. You studied at New York University, is that right?
Yeah.
And what was the course that you did?
It's a postgraduate course in real estate. It has a very specific name, which I can't remember. Found on my CV somewhere in LinkedIn probably, but and it was a fantastic course, but it got cut short because of September 11th. So in the end, I'd never graduated from it, which I didn't mind. I wasn't there to get the degree, although maybe it would have been nice, but I was there to actually learn something.
Yeah.
So I'd moved, and then in September 2000 joined NYU, and then there's a course with modules. So it was 18 months, I think.
Yeah. So you did that, build a bit of a network, got a bit of an understanding.
I did that. I mean, it was part-time. It was in the evenings.
Okay.
And built a small network. New York's a great place to build networks and to network, but if you're the new kid on the block and you're not bringing much, it's not that easy. But I had lots of friends who knew people there, and it was easy to build a network of friends and also business contacts. That's a long time ago now. I wouldn't call myself a New York expert in the real estate world anymore. or ever.
So you landed. What was your first role within real estate? Once you graduated, I know you kind of mentioned it's part-time, but what were you actually doing?
I worked for a German real estate business that had a portfolio of assets in the US, and I was tasked with sort of overseeing the reporting of it. There was a lot of German debt that was behind it, and I kind of became the relationship person for the local guy on the ground. So there was no one there before I arrived. I came, I set up that office, and really just initially just reported back. And then as I got more confident, started getting more involved in working with the local asset management partners. So there were properties all across the east side. So down from Florida all the way up to Boston. Yeah. But mostly in Florida. Strip malls, office buildings, everything commercial, couple of hotels, all on different agreements. And it was very easy for the first year. And after a year, there were a couple of projects that started becoming more difficult. And that's when I really started to learn as well. By that point, I understood better what was going on. And not just from the course, but just by watching and seeing. And, our industry isn't intellectually that complicated. So you pick things up if given a chance. But it took me definitely a year. And I traveled back and forth to Germany a lot. So went back to the headquarters in Germany and reported back. People came out probably every month. So that was my start.
That was your grounding?
That was my grounding. It was very interesting. Things work differently in the US, of course, than they do in the UK or in Germany. But the fundamentals are the same.
So how long were you in the US for before you kind of moved back?
Just shy of 3 years.
Okay. And so we're talking, kind of 2004, 2005 when you came back?
No, 2002.
2002.
I came in 1999 and I came back 2002.
You came back to the UK?
I came back to the UK, yeah.
And what prompted the return back to the UK, and why did you come back here?
The German firm started pulling back from the US. .com sort of, a little bit of a .com bubble that had burst, and suddenly banks weren't that excited anymore. And there were some personal reasons that made me come back. My then girlfriend, now wife, had a loss in her family, and she needed to be back in Europe.
Yeah.
So there are a couple of reasons to come back. So we did. But when I came back, I was hooked on property. It was kind of the career I'd wanted. And so I tried to find my way in the UK, which was very different. Suddenly there were all these RICS credit, and I didn't have that. I didn't know that it existed.
Yeah.
It wasn't a thing in the US at the time. I'm not sure it is now either.
I'm not sure it is now either.
It is in Germany, interestingly. People recognize it. But I had done the university. I didn't feel I knew everything, far from it, but I didn't really want to go back and started retraining. And I also now needed to make money. I needed to make money before as well, but I was paid quite well in New York, and I had some savings from before, and they were sort of dwindling down. I was getting married, so I had to be real. But through personal relationships, I found a small developer called Landmark Securities. It's a grand name, but it was actually quite a small business. And I started working for them and became, I guess, a partner in the business, because they didn't want to pay me a lot of money. So they said, fine, but you can take a sort of stake in the upside on every deal that we do together. And my role really was to bring German banks into UK real estate. So I had all these relationships with German banks investing in the US. Quite a few were active already or still, looking at the UK. And it was the early days before the banking world really exploded. So it was a reasonably opportune time to do that. So I started doing this for this developer and got involved in a couple of projects that they did. And then very quickly, we were working with a UK private equity fund who provided equity. I was bringing the German debt. And this fund was moving into investing in Germany. And because I was German, everybody assumed I know about the German property market, which I had never worked in really. So I went to Germany and met with people there to find out what goes on in the German market. And I know it sounds crazy in the world that we live in today, but it was all much less transparent back then. There was a lot less data. We had the internet already, but it wasn't that easy to move around into different markets. And speaking German with, my father having been in the business in Germany successfully opened a lot of doors. So I was able to find some investment opportunities that were probably not that easy to source for external people that didn't have this sort of leg up. And so we transacted on behalf of this private equity fund.
At Landmark?
At Landmark, on a fee basis and a whole complicated share in upside. But after 3-4 deals, that P fund, which is Stenham, said, why don't you guys join us? We are backing your UK developments. You're now helping us, source assets in Germany and transact in Germany. And so they bought our business. And I became a director at Stenham and had some shares in the business. So now I was in private equity real estate in London. So it worked out until that point pretty well.
So the risk at the time was, you needed a role at Landmark, right? So you took a bit of a pay cut, but
I took a big pay cut at Landmark. But at that point, I don't think I was desperate, but come back from New York, it wasn't an easy time. And it wasn't that easy to get that job. The first time I was looking to leave financial comms and I was having lots of conversations while still in a job. And then this opportunity came up. This time I was leaving for personal reasons mainly. And I needed to find a job. It's a different position to look when you don't have anything. So in the end, when that opportunity arose, I grabbed it, and the pay was very low. But, it gave me, in the end, joining Stenham, I had upside shares in these deals, and it gave me a position to get some shares in Stenham. And the timing was phenomenal, through luck. Few years later, Stenham was bought out by another bigger business that paid a big premium. And we were now moving slowly. This was 2004, I think. So we were moving at the beginning of that great debt-driven boom that led to the global financial crisis, 4 years later. But when I joined Stenham, there were 150 million of AUM on the real estate side. Stenham had various businesses, real estate, fund of hedge funds, trust business, and other bits and pieces. But on the real estate side, it was small, and we grew to 3 billion in the next 3 years. So
lots of transactions, lots of experience.
There was a period I think we bought a building a week.
Wow.
And lots of transactions, huge amounts of debt. Very much part of that story of that time. But very entrepreneurial management team, very unique investor base in that we had private investors, over 2,000 private investors who were pooled into these closed-ended funds, but there were strong personal relationship, not to 2,000, but to a lot of them kind of grouped together through introducers. So there were strong personal relationships to either the individuals or and kind of introducer. And the investors were supportive, and management, I think, was incredibly focused on getting through the difficult times that we did ultimately, have to deal with. And so Stenham, I think, ended up working its way out of the financial crisis quite well. So I had an incredible ride there. First, I was on an absolute growth boom, and building a big team, building a big portfolio, raising money at the same time. Not just me, of course, but I was part of that story. And then I had that humbling experience of working ourselves through really, really difficult times. And while definitely not every investment ended up being a good investment, overall, I think we came out pretty well. But the world had changed, and I made my move in 2013, 14, because I kind of felt I wanted to really get stuck into the bricks and mortars, as we say in the UK, of the real estate. I wasn't disillusioned, but the job in private equity, at least the way that I was perceiving, was we had investors on one side, and and a lot of our strategies were sort of value adds, some way even opportunistic, but certainly, core plus. They needed management, and we nearly always teamed up with operating partners. And it felt like taking money from one side and passing it through our conduit, which I appreciate added hopefully quite a lot of value in that we sourced them, we due diligence them, we oversaw what the partners were doing, but we weren't really involved in extracting the value out of the real estate. We didn't really work with the real estate. We worked with maybe the partners and the money.
Yeah.
Added leverage, and structured these transactions, from tax or whatever was required. But I wanted to work with the real estate. And so, in 2013, I said, it's time to give that a go.
And I guess it's such a crazy journey that you'd been on deal a week, that kind of 10-year period where you were in corporate comms or what have you, in comparison to your peers, you probably just came right up level in terms of just the experience that you'd gained through all the transactions and the work that you'd done, and kind of closed that gap. Obviously the global financial crash was a challenging period, and you touched on the fact that you came out of it relatively well. What were one of your biggest reflections or learnings from that time?
Open communication. It's still very much a mantra for me. The key was to speak to our investors, to be obviously honest about it, but to be very proactive in communicating with them, explaining them what is going on, explaining them what you're doing about it, even if you can't magically make it amazing. But that was by far the biggest lesson that I've learned. I mean, there were technical lessons I think all of us underestimated or weren't really that aware of the risk that high leverage brings. Theoretically, it seems very obvious now in retrospect, but at the time, I maybe also because I was still much younger, it felt this is only going to go one way. We didn't really understand a lot of the products that were underlying the global financial crisis until after, and we just saw everybody growing and running. So we decided, let's grow and run as well. This is the time. And but the real lessons learned were the more the human lessons, the way that investors react. We never had, when communicating a loss to a private investor is a very difficult thing. People get very emotional about it, but the key was to communicate openly, and that stood us in good. Put us in a good place with investors, despite the difficulties.
Yeah, I guess humans inherently, especially those in the real estate industry, I'm finding, have got relatively short-term memories, but it doesn't sound like you do. It sounds like those kind of lessons that you've kind of learned stay with you now, and form or inform how you kind of do business. So moving to 2013, you decided that was the time to set up your business. Can you just tell me about how and why you decided to do that, and why did you feel that was the right time?
Like I said before, I'm a bit of a property romantic. I like buildings. I like the process of actually building, or at least watching it, being involved in the creative side of it. And by 2013, I felt that Stenham had been sold during the period running up before into the global financial crisis. So I had less upside really to gain. I was a very well-paid employee. It wasn't really exciting. I didn't feel I was building something at the business, and I wasn't working on the development side of the real estate, so the actual physical bricks and mortar. And I always had this kind of dream of being my own boss, doing my own thing. So the timing felt right. I took the plunge, and I set myself a very kind of clear strategy. I believe that, I want to be really good at one thing rather than try and do something everywhere, which in private equity to a degree is what you need to do, because you've got to move very quickly from whatever is hot right now is the place you want to be. So I've settled on London as the place to invest in or to work in. And I always like commercial real estate. I had the most experience with commercial real estate. At Stenham, we had lots of different strategies, hotels, residential, but commercial seemed the place that I was most comfortable in, to me. And I went out and I found an investor to back me. So I had a core investor when I started the business, a family office, UK based, and that backed the business and provided equity to start finding deals and then bring in partners. So I kind of felt I had all the bases covered, knew what I was doing, had enough experience, had the money, but it wasn't that straightforward. It was quite lonely at the beginning. I started the business by myself, and so on day one I was completely by myself. The family office that backed me provided a lot of infrastructure, so accounting and back office where I could plug into. But in terms of turning up and in the morning at the office, took a little serviced office because I had small children and I was working from home wasn't a thing yet, so it wasn't even a consideration for me. So I took a small serviced office, and I quickly learned who the real friends were that supported me. But while I had some money behind me, the friends were there, and we started doing deals. And I quickly realized that the relationship I had with that family office wasn't the right one for me as well.
Before you get onto that, because someone listening to this who's sat in a business at the moment going, I really want to set up my own business, now is the time, bit of a dip in the market or opportunity that they sense. you left, and did you spend some time thinking about the strategy and the plan and then going to the money? Or did you tee up the money before you left, agree the plan, and then you went with it? You know, I know there's covenants and other things you need to be mindful of, but chicken and egg, how did you genuinely do that?
I had a strategy, a high-level strategy, and when I understood what the money was looking for, when I thought I understood what the money was looking for, I made the strategy fit the money, as we probably do now as a business. It's not that we don't have conviction, but it's that the money needs a certain kind of approach. Maybe it's more short-term than that worked for me still. I was still focused on commercial real estate in London. But you know, if you want to set up your own business, I guess you need to roll a little bit with the punches. It's my experience. I never believed in absolutely, totally fixed plans. I think it's really important to have a clear vision and a clear roadmap ahead. And it's equally as important to have the flexibility to deviate from it when there are roadblocks and stones in your way, or when opportunities arise on tangents that you can go after.
Did you go and pitch to lots of other family offices or types of capital, or was it through your network?
It was through my network. It's really difficult to go and pitch to external professional, not people that you have a personal relationship with or an introduction through a personal relationship when you're starting. I think unless you have, a lot of track record with these people before. So if you've been working in PE and you want to set up your own PE fund, and you've got GPs that have backed your funds for a long time and they trust you, that's a different story. But if you're kind of changing into becoming a developer, coming out of a PE background, they will back projects, but to back you is a different story with money. Or you go and work for them. That's another story. But I didn't want to work for someone. So I knew quite a few investors, and one of them said, "Yeah, I like commercial real estate. What's your business plan?" And so I showed them my business plan, and they said, "Okay, that could work, but we need these three things slightly different." So we worked it out how it could work for them and for me, and off we went.
So you had the money, you had the plan, and then you needed to go and find the assets and the deals, right?
The money had the plan, needed to find the assets, which we did. But I think my plan was ultimately probably quite different to what the family office's plan was. And my plan was be really focused on commercial real estate. Their plan was, let's do everything that sounds exciting. And in the end, they had lots of other ideas that I wasn't interested in pursuing within the space of real estate. And it was frustrating for them because I kept saying, this is not what I want to do. It was frustrating for me because I was spending a lot of time looking at things I didn't want to do. So after a couple of years, I bought out their share, repaid the money. I'd been fortunate that a few of the early deals we'd done had been quite successful. And we could exit them. And then there were a couple of deals that stayed that I was managing now externally, that all, within 18 months, I think, we were able to exit, and they were all successful. We had also quite a good period in the market. So it wasn't, I was lucky on that part, but I was able to buy back my shares. And now, control the business alone. The team had grown a little bit by then. So from being alone, we were 4 or 5 people at this point. And we had a few projects on the go. And so we could attract other investors more easily. And that's what we did.
You had a track record, bit of a team, bit of an infrastructure, a bit more proven.
Exactly.
And so at the time, your kind of main investor, I'm assuming you couldn't go and work with third-party capital. That was part of the deal, working with them as an extension of the family office, right?
No, the idea was very much they wanted to leverage, and they were obsessed with leverage. They wanted a lot of leverage. That was also one of the kind of complications that we had. So they said, look, we want to put our money in, we want to take our money out really, really quickly. But they wanted to, I guess the whole point of leverage is to get a benefit of other people's money. So bringing in other investors wasn't that difficult, but bringing in other investors and saying, I rank ahead of you in my sort of return was more tricky, at least the way that we were proposing it. So it was possible, but not in a way that I think I was able to grow the business.
Yeah. So at this stage, made a little bit of money, done some projects, gained great conviction in terms of your strategy and the direction in which you're taking the business. Was your role as kind of the founder and CEO to go and find third-party capital to keep backing you at this stage, or what was the
role was still very much at that stage was still very much to do everything. Find the money, find the deal. It's the sort of classic chicken and egg in our world. And we had a group of investors by now that we had relationships with, who backed some of our early deals or who noticed us or were introduced to, and it felt like there was potential to do something with them and understood what their requirements are. And the ones that we felt would be a good potential fit to the kind of deal flow that we were looking at, we stayed very close to. And then we looked for really good deals. And when we found something, we thought, okay, this makes sense. We can do this. We underwrote it. It's still as we do today in many ways. And hope that one of our investors would like the way we approach it and the way we think about it. And then, of course, the returns that we're projecting. And then build it project by project, deal by deal. But once you get a relationship with one investor, that tends to build into a couple of deals. So there's still quite a small group of investors that we work with till today. But it's a varied group. It's sort of a little bit more than a handful of investors.
And do you line deals up with individual investors, or do you club them together and so they're all syndicated? Or
no, we try. Well, it's not we try. We don't club them together. There's one or two that have been clubbed together. I'm not a big fan of it.
Just differences in terms of obviously it enters challenges that you probably could do without, just in terms of people wanting to exit their money and secondaries.
So on day one, with the club on day one, everybody is on the same page, everybody's excited, there's a clear business plan, but the reality is that the business plan will probably change along the way. The markets change, the assumptions that are in there are based on the kind of knowledge we have on day one, but 2 years later, the world's a different place and there are different needs. And equally, individual investors suddenly have events in their world that might require them to create liquidity or change their sort of strategy. So there's potential for tension. And there isn't... is there an advantage of having club deals? I think if one is... one could say that the advantage is that as the investment manager, you can sort of divide and conquer. There isn't one person who controls the money who can, pull the rug out from below you, but everybody's dependent on you, and that gives you, a strength. But I don't feel that that's, the way I want to run my business, is to divide and conquer. And I guess if you get a very wide and very large group of investors, then that's a very different business, investment management business. But there are also regulatory issues with once you start to market yourself to a wide base, you are managing people's money, and we don't manage people's money at the moment.
Yeah.
So all our assets sit in SPVs. These SPVs are owned either entirely by our partner or controlled by a partner, even if we are on the board and do the day-to-day administration of those companies. And we earn fees and share in profit and upside, and we co-invest. So we have shares in these SPVs, but they usually, well, they're always in terms of the size minority shares, and it's a simpler kind of way to structure.
Yeah. For someone who hasn't come across WRE before, we've spoken a little bit about product or real estate. Can you just tell me about the criteria of the kit that you look for? What are the assets that you hone in on? And has that evolved over the years, or have you kind of kept that relatively fixed?
We're still sticking with commercial real estate and London, but I think the way we look at commercial real estate today is quite different to how we looked at it 10 years ago when we started a business, or coming up probably 12 years ago, nearly. In that commercial real estate being predominantly offices, and offices, of course, post-pandemic are seen as very different places, which we actually believe is a really exciting time to be in commercial real estate. I mean, clearly there are challenges, and I don't think the jury is still not clear on where we will end up with the office product, but we're confident that the place of work as an office has a future. So that has tweaked, and I can speak a little bit more about that later. But other than that, not so much has changed. We are still looking for buildings that we feel have extracted potential, either in the way that they're being used or designed. Maybe we still try and find areas that we believe are underserved by good office product. So we've got a site in Parsons Green, for example, right off the green, really great opportunity for an office development there, which is hopefully going on site in the next few months. Just about to appoint a contractor, and we've got our Arding and Hobbs department store, which we're turning into a mixed-use but office-led scheme by Clapham Junction. So there is still opportunities to maybe find pockets of London that aren't, clear traditional office markets that have potential. But that's not the main strategy. We're not saying we're going out to find the next best place. If I find a great opportunity in Soho or Mayfair or Borough, I'm equally as excited. And then often it is an opportunity where there's a building that has become a little bit unloved, is of a certain age, needs investment, and maybe and probably at this stage, rethinking about how it's used. What does it stand for? Why would this be a great place for people to come and spend their day? Not every building can offer that easily, but many can, with some imagination. And that's the part I enjoy the most.
I can tell. I can tell you think a lot about that.
I think a lot about that. I think a lot about how we interact with buildings, how the buildings interact with the community that they sit in. I get excited about engineering solutions. I'm not an engineer, but I get most joy speaking to the engineers, the architects, than to the finance aspect of it. Although that's where I come from, but maybe that's why I enjoy this new part so much, because it's newer for me, and still after 10 years of doing this now is the part that I enjoy the most.
Can you just give me a bit of an overview of the business at the moment? Assets under management, number of projects, team, etc., for people who haven't maybe come across you before.
Yeah, I should know these numbers better, but because we're not a corporate fund, I don't sort of track assets under management. But I think we're about 1 billion at the moment of assets under management. That's gross asset value. So this is not money that we manage, but actually the value of our buildings. Although in the current market, it may have come down. A lot of times, particularly when we back up with private, we don't value these assets on a sort of quarterly or even annual basis, but I would say it's around 1 billion. We've got some major schemes developed at the moment. I mentioned the Arding and Hobbs department store in Clapham Junction. We've got a big project in Camden by King's Cross called St Pancras Campus, which is really, really exciting. It's a mixed-use development, an old industrial site that is going to deliver brand new office space, but also residential buildings, which were part of the planning arrangement with Camden, and replacing the industrial use, but integrating a pocket park into the site. And I think it's pushing it too far to say, we're not creating a new neighborhood, but we are really impacting this location. We've got a development in Borough High Street that is completing in October, smaller scheme, and the Parsons Green project. We're looking at something new around on the South Bank at the moment that hopefully we can announce soon. So we're busy. In terms of a team, I think it's 7 people. So we're very compact still. But one of the things I love about working in London is the access to really high quality professionals across every single area is phenomenal. Compared to other markets that I've worked in, although I haven't developed, but I've invested in and kind of seen the quality of external professionals. It's in the UK is amazing. Project management, cost consultancy, also the way that engineering firms interact with developers is very, very user friendly and a really, really great resource. So we can staff our projects with people that I couldn't afford to have in the business on a full-time basis. And it's worked well so far. So I'm not looking to grow my business big for the sake of it, but I'm quite happy to keep it small and resource every project well.
Where does data and tech fit into your decision making? From an investment perspective, but also building best-in-class sustainable buildings as well?
I think the industry is slowly only waking up to data and tech in various areas that we are not driving directly, but like we talked also to mention sustainability. So in sustainability, we work with sustainability consultants in order to help us understand how we can build better, what is the potential of creating a building that is going to perform in a sustainable way going forward. And we are seeing those consultants increasingly using a lot more data than they were before. This is still very early days, but it's changed massively in the last 5 years. And that, I guess, helps us then come up with a proposal to underwrite an investment on the back of that kind of data. But we don't have that data in our business. So, ESG credentials as a whole, but sustainability probably being the one that is easiest to define, although it's still far from being easy to define. Are considerations for us, are considerations for investors and other stakeholders in buildings. And we're seeing data becoming a big element of that. But most of the investment decisions are still done on quite traditional basis. We get comp schedules from agents. They're might be digitized now, but they are digitized now, but it's not very high tech. And take views on a lot of hard kind of number crunching that we do ourselves through using Excel mostly. So it's not as exciting yet as I think it might become.
What with AI and?
I think AI is obviously going to impact everyone, and I am not an AI expert, but it's going to be really interesting to see where it comes strong and what it will deliver. I think when I speak to some of our engineers, for example, they're really excited about the technology that they're able to use to design buildings and structures. But if you look at most constructions, it's all in London, so pretty. Not that much has been innovated. But it is changing. Every day we see bits and pieces, some new ideas coming through. But it's slow. And buildings take a long time to develop. They are developed hopefully for a long period. So that once they're there. And to renew it and to change it, could be 20 years before a new building gets actually the once over to introduce new technology and new ways of doing things into that building. You
refurb and retrofit heritage buildings as well as develop brand new buildings, right?
Yeah, mostly we refurb and retrofit. We've got 2 new builds, both on sites that we didn't, the St. Pancras campus was a low-rise industrial site. Most of our projects are refurbishments or retrofit projects, which has its challenges, but definitely.
In terms of getting increased massing or getting further floor space to make the capital value
you just constantly
stack up,
get surprised by what you find, and it doesn't matter how much you survey a building or look into it, particularly with older buildings. And it's much harder to work with something that is half built. You have to fit everything into that existing structure. And when you buy a building, you have, I would say, close to no idea of what this building is really all about, because very rarely can you go and knock it around and really have a look. And even when you do, you test one column, you test 2 columns, but then the third one ends up being different, for reasons that are difficult to explain. So there's always something you find on a retrofit building, but you also get the character and you get the history and you get lots of other really exciting elements with it, and particularly with beautiful buildings. So there is there is something quite exciting about doing that as well.
There's a lot of chat and noise in the press. Lots of commentators are saying, the death of the office and the challenge of the office. And a lot of North American investors I'm hearing don't want to go anywhere near it. What are you most excited about from an office investment perspective at the moment?
So many challenges are facing the office sector that I think we're going to come out with quite a different product going forward. My feeling is that the office is absolutely, for the first time since I'm in my life, the question of what is the office for was raised, and not just by professional investors or developers, by everyone during the pandemic. Everybody was saying, "Oh, are people going to go back to the office? Do we need office?" We're seeing companies increasingly reverting, saying we absolutely want an office and we need an office. but they need it for a different purpose than they did or than they thought they did. Originally, it was about giving people tools to do their job, just like factory workers had to come to the physical place in order to use the machinery. Office workers had to come to use the computers, the fax machine, the printers, all of these items that now they can use quite easily from home. They also had to come to the office to speak to one another, which now through technology they can do to a degree. But they also came to the office and fed off each other outside telephone calls or Zoom calls. And this is a well-discussed topic. So it's about culture, it's about learning, it's about bringing people together to innovate and challenge each other. And those elements are really core to a company's success. And so companies really want their staff back in the office. And in order to do that, they need to create places that are exciting to come to. And I don't think that staff comes to the office because of better coffee or because they've got showers. I think those are definitely making the experience from a physical perspective more attractive, i.e. offering them freebies and maybe nice arrival experiences is helpful. But it's about finding purpose and people want to learn. They want to be part of a team that is growing and innovative and going somewhere. So getting an environment that allows that innovation, that teamwork, that collaboration is what I think will be the office of the future. And lots of people are doing it, and in many cases it's working really well, and in many cases it hasn't taken off so far. But it's the jury's still out. We're not through this yet, and it will develop, and possibly will need less offices.
Do you build offices that you think occupiers would want, or do you talk to occupiers and build what they want? I'm just thinking of your Parsons Green project, for instance. Do you kind of build what you think is going to be best in class for that particular location, or do you try and talk with potential occupiers or customers in advance and get their input into it?
It's kind of a circle, I think. Probably we build offices that we think people want, but not making up what we think they want because we were so convinced of knowing everything. We speak to lots of occupiers where this is now not our first rodeo, so we've got other buildings, we saw what works, we saw what didn't work. But we are speculative developers mostly, so we're not building for a specific occupier, and every occupier wants something else. So what we try and do is build offices that have this lots of flexibility built into it, and not just for the first round of letting, but also for the next 100 years. In terms of sustainability, the offices that we develop, we want them to be there for a very long time, and not they will change internally, but the structure, the sort of core of the building should be flexible enough to accommodate lots of different types of users. And so that's, I guess, the way we do it. But increasingly, we are working with operating partners where from day one, we're saying, we're actually going to bring in a service provider. Who's going to run that office for us? In the old days, it would have been a serviced office provider, and now they all want to do management agreements. So he says, this is a service office provider doing a management agreement, but we actually don't see it like that. We just see that we're adding a layer onto our building in order to let that building, but on different terms than we were letting it before. And yes, there's costs for me as a landlord, but if I can get comfortable that I get rewarded for providing that service, and just like I've got an external project manager and an external property manager at the moment, I now have an external flex service provider that doesn't just provide property management services to my tenants, but actually provides a better arrival experience, meeting rooms that can be rented, the option of having a fully fitted office on a Cat B basis. So all of these elements we're adding on. And so when we're working with these service providers, they have very clear idea of how they think the offices should be used. And so when we develop it, we tweak it to fit that market that we're going to be targeting. So it is changing. And it's an exciting time.
Talk to me about the decision to become a B Corp, because it seems like you're quite early on in that process or that journey in terms of deciding or being one of the first developers to do it.
We kind of understood as a business that we wanted to do something in order to challenge our whole ESG approach. And to be honest, we looked into this world that nobody could give us we didn't really know where to go. So B Corp was an accreditation that started becoming, it was quite interesting. I saw some brands that I liked were associating themselves with it. So we looked into it. And it was reassuringly difficult to get. So it felt like it was meaningful. It is meaningful. And so I went to our FD and I asked him if we can look into this. And I think he didn't read the information too well, because he said, yeah, I think we can do that. So I said, great. So you're going to run this project.
Yeah.
It was during Corona that we went, and it took about a year to get through it. But it was actually a really interesting process, because it did challenge a lot of things that we did. And don't ask me the details. I don't remember too much, but there were, from simple things like changing the way we dispose of our rubbish to how we procure contracts, and it was an interesting journey. But we also learned that that's probably not enough. So we've been going through our own separate ESG analysis. We're going through it at the moment. We're halfway through it with, which is a much more detailed, much more bespoke service as well. So I think being a B Corp is a really interesting process, and it's an ongoing process. You've got to kind of reapply or get recertified, I think every 2 years, if I remember correctly. So we can't let our guard down. But there's more to do.
Yeah, I can only imagine. So as we draw to a close, the question that I ask everyone that comes on the podcast is, if you had £500 million of equity, who are the people, what property, and which place would you look to deploy that capital?
Yeah, so you warned me that I can't say I would all employ it into my fund, but as I don't have a fund, that's not too difficult. I thought about it a little bit in the run-up to this recording. And when I started working with these German banks in my first sort of real estate job, I had my first meetings at a German bank, and there's a banker, and she told me, says, all the real estate that you ever buy, it needs to be close enough that you can bicycle to it. Which I thought was a bit of a funny thing to say, because here she was sitting in Germany and we were investing in New York, and but there was some truth to it. It's a very local game, I think. If you're a developer in particular, you really need to understand your patch. There's so many quirks. I'm sure if I went to Coventry, I wouldn't know. It'll take me a long time to understand what is actually going on here, really on the ground. So if it was my money, I would probably still invest it in London. I think right now, if I'm being with my private equity hat on, that I don't have anymore, but in my old hat, I would probably look if there was some interesting commercial real estate debt to buy. The world is still really in shock of everything that has happened to commercial real estate, and I think there's some really probably good opportunities to buy into that space. But ultimately, I would continue to back London and continue to back good development opportunities. So I know that's maybe not too exciting.
And the people, is there anyone you bring on the journey in terms of helping you deploy the capital?
I take my team. I mean, am I allowed to take my team?
You can take your team. Is there anyone else you would add into your team?
You can come.
I can come. Look at that.
If you would like to.
You spoke about best in class.
Yeah, exactly.
External providers earlier. I'll make a note. Well, look, Sascha, I feel like I've got a lot more questions for you, but something that certainly stood out was the honesty around how lonely it can be as a solo founder. I definitely kind of could relate to that, being a solo founder myself. So thank you for a very honest account of your journey, reinventing yourself, taking risks, backing upside, having kind of strong conviction and making difficult decisions with when to part. I've been fascinated and I'm excited to see what you and the team go on to do and how you navigate this next part. So thank you so much for sharing these insights. I've really enjoyed it.
Great. Thanks a lot. Yeah, me too. Really enjoyed it.
Cheers. Thanks, Sascha.
Thank you.
Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests we should get on the podcast or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for investors, owners, developers, and operators. So if you're considering your career options at the moment or looking to attract top talent to work for you, head over to the website www.rockborn.com, where you can find a wealth of research to aid your search. Have a great day wherever you are, and I look forward to catching you next time.